Good morning, everyone, and welcome to the Forbes Investments webinar on global investing. We're delighted to host you and honoured that you've joined us as we unpack the current trends around global investing and the developments and changes that we've made with our offshore offering at Forbes. I'm Mandy Porter. I'm a senior financial planner at Forbes. And today I'm joined by Alex Kokorev, the head of governance and approved products from the best practice team, and Makazonke Madi, or Mac as we know him, a portfolio manager within the investments team. Welcome, gentlemen.
Thank you, Mandy.
Investing globally can play a significant role in further diversifying an investment portfolio, lowering the investment risk, and also contributing to the savings and investment growth opportunities available to investors. But many investors may be missing out on these opportunities due to a low-risk appetite and anxiety about investing in offshore markets or not having an understanding of the options available to them. And that is why the value of personalized financial advice cannot be underestimated. We have seen that there are a number of reasons investors look to invest offshore. They could be thinking about risk and return, they have currency concerns, or they just want to diversify their investments. South Africa's local equity market is one of the world's most concentrated. So investing abroad, however, taps into a large universe of not only shares, but other asset classes across a global spectrum. To help us sift through everything and try to make sense of it all, Alex will give us a brief overview of the benefits and the things to consider when investing offshore, and Mac will explain the Forbes and Mercer's relationship, as well as the reasons for the restructuring of the equity fund. So Alex, I'm going to start with you. What are the benefits of investing offshore, and how easy is it to invest offshore, and what if I don't have much money to invest?
Sure, Mandy. So the main benefit of investing offshore would be widening your investable universe and having an exposure to certain sectors, geographies, or industries that are potentially not available in South Africa or might not be investable grade or even listed. So the diversification is also can reduce the risk of the capital loss in hard currency. Take into account that the rand is the emerging market currency, and it's a commodity currency, and can be quite volatile, especially if the client does have a recurring international liability and might not have the time frame to wait for the currency to recover. And from the accessibility perspective, I mean, we do definitely see it's getting easier and easier and to take your money offshore from a product provider's perspective. The providers are permanently coming up with a new offering. Some providers are coming up with enhancing the existing offering. And even from the banks and from a currency exchange providers, those processes, the costs are improving, making it more accessible to the wider market. The market is obviously getting more competitive and it's driving the prices down. But taking that into account, we can't just concentrate on pricing, because if I look at currency exchange providers, at one stage in South Africa we had 120 providers. It was a small change in the regulatory requirements or pandemics. Not all of them will be able to sustainable, because some of them will be accepting business at unsustainable pricing. So we need to really be cautious on who do you want to partner with as your strategic provider or a supplier of that. So we need to be kind of cognizant to that. And with regards to options available to clients, so I mean there are multiple vehicles available in South Africa. It caters for every client's need, goal, objective, or a budget, be it from a debit order perspective or be it from a lump sum perspective. So I think the most commonly utilized vehicles in South Africa would be your offshore feeder funds, your offshore unit trusts, your offshore lisp wrappers, and your offshore life wrappers, or we call them the endowments or the sinking fund policies. So all of them are available to the clients, and I mean we can dive into those details of that specific products later in the questions. But yeah, so that will hopefully that answers your question.
Okay, yes, and I mean you mentioned local offshore feeder funds. Can you just give us the difference between investing directly offshore and investing in a local offshore feeder fund?
Sure. I mean that's a very common question. So let's look at offshore feeder funds initially, right? So the offshore feeder funds are rand-denominated products that are linked to an offshore fund. So even if you look at the fact sheet of the offshore feeder funds, it will have, let's call it 98% exposure to the feeder fund and have some cash component to be able to fund the rand liquidity because it's more accessible. It's from a liquidity perspective, you can access it within like 2 to 3 working days. It will price very similar to your local unit trust. You do not need to utilize your single discretionary allowance or your foreign discretionary allowance to invest into offshore feeder funds. So you will see from an entry-level perspective, this is something that the clients can consider because even from the minimums perspective, the asset managers will allow you to have a debit order investments and the relatively small premiums, which you potentially cannot be able to do it on your offshore unit trust because you will need to do a foreign exchange for every time you allocate money to that. And so your premiums will be slightly higher on an offshore unit trust. Obviously, you will need to utilize one of your allowances, be it your single discretionary allowance or your foreign discretionary allowance. And you also need to take into account certain costs. So, for example, if I'm utilizing my bank that will charge me a fixed rand fee to forex my money and my debit order into my offshore unit trust is 1,000 rand. So basically, I've got 750 rand goes to market. So my underlying portfolio has to do 25% return just for me to break even in order to be able to set it. So you do want to you want to try to ignore this and then do it via lump sum investments. So, and that what potentially would be the main difference between the offshore feeder funds and an offshore unit trust. And from a tax perspective, it's also quite different because one is the rand denominated, one is the dollar denominated or the hard currency denominated funds. So from the tax side, one will be taxed on a rand gain and one will be the tax on your hard currency gain. So that's for clients need to be considered. And let's use an example. We'll have in unit trust, offshore unit trust, that underlying portfolio done 10% return in US dollar over the year, and your rand has strengthened to the same amount, or let's call it, or dollar weakened to 10%. So in rand terms, your actual investment has zero growth. So you really need to take that into account. So so potentially it may be not as tax efficient, or especially if you're tracking a hard currency liability, like you need to pay monthly school fees in UK for a client. You want to make sure that liability is tracking, one is keeping up with inflation and tracking the currency performance. So in that case, that might not be a suitable option for a client to utilize the feeder fund. So there's a pros and cons of every single offering. I hope that answers your question.
Yeah, and take us through the size. I mean, does one need to get size clearance, and what if your tax actually isn't up to date?
Yeah, so so just kind of one step back. So we've got two sets of allowances, all right? One is your single discretionary allowance, which is 1 million rand, and it's per calendar year. Right? So then you've got your second allowance, which is your called FDA or your foreign discretionary allowance, which is your 10 million rand. That's also per calendar year. So in other words, a client has got a facility that allows him to take up to 11 million rand per annum abroad, which does cover majority of the South African market. So from the SARS tax clearance perspective, from the single discretionary allowance, that is not relevant. But if you want to be applying for a foreign discretionary allowance, you need to make sure all your affairs and all your submission to SARS are in order. Because what you don't want to have is you don't want to have 100 rand outstanding to SARS that potentially can trigger a rejection of your tax clearance certificate. And with the current capacity constraint with SARS, the turnaround time for a tax clearance certificate is can go up to 21 working days. And especially now with us approaching the end of the calendar year, I think the clients and advisors need to be cognizant to that we don't want to trigger a second round of 21 working that's waiting for that clearance to be approved.
And if you want to bring your money back, what are the tax implications around that?
Yeah, so from a tax perspective, obviously when you're selling your units or you're withdrawing funds from your investment, there will be a CGT implication. Right? The CGT implication is obviously looking at the difference between your weighted average base cost of the unit and the market value of the unit or of the fund at the sale date. Right? That's what's going to be considered as a capital gain tax. So if you're looking from a different product perspective, you'll have your offshore unit trust or your list wrappers that are taxed in clients' hands, so it can be quite onerous. And if you're looking from the various providers, some providers will provide you with the tax certificates, some of them will not. So predominantly the providers that are playing in the international space, they're playing into kind of a multinational target audience, they might not be able to generate those tax certificates, and the client need to make sure they're responsible for declaring and paying those taxes. And then you've got the likes of your offshore endowments, where the products are actually taxed within a product, right? And then those products are predominantly suitable for the clients that are in a higher tax bracket, because they're not taxed at the client's marginal tax rate. They'll be taxed at a 30% tax bracket, right? And so one is obviously it lowers your income tax rate, if applicable, because most of the providers are utilizing roll-up or accumulating funds into the portfolios. And then from the CGT perspective, while your unit trust, yes, it does allow you for your 40,000 Rand tax exemption that's currently available per annum. And then thereafter, the effective rate is 18%. With the endowment side, your effective rate is going to be at 12%. So that would be the pros and cons of that. But it's key to note that on a purchase and endowment side, the client will be paid net of tax. And that's quite key to consider, because what you don't want to do is you don't want to chase a follow-up repurchase, because client actually underfunded the repurchase and didn't expect for the tax to be subtracted from the withdrawal. So there are different pros and cons of each product, and it's all about the application and the suitability for that specific need of the client.
And can you tell us about the Alexander Forbes products specifically and the tax implications thereof?
Sure. So from Alexander Forbes product set, and maybe let's touch on our approved product set that is available to the advisors, because there is a pros and cons of every product, and that's why we're not just looking at Alexander Forbes products. We've got third-party products on our approved list. That's why we do quite a stringent due diligence processes in approving or adding those products or removing the certain products from our approved product set. So let's touch on the hard currency products. So starting with the offshore unit trust, we've got accessibility to our Alexander Forbes Jersey portfolios, which is our strategic range, and I'll leave it to Matt to touch on that on that range as a portfolio manager. Then the second tier we'll have our offshore list wrappers, which is your multi-linked unit trust investment that allows you to have a capability of access to those multiple asset managers or wider variety of funds into one product, right? So from that perspective, we've got our internal product, which is our Alexander Forbes global platform, or F Global, right? From the third-party providers, we've got Allan Gray, and we've got 91 global investment portfolios. I think that is sufficient in order for us to be able to cater for that specific or variety of needs, be it a specific portfolio selection that the client needs for that specific product. And on an offshore endowment side, we've got Glacier, Global Life, and we've got 91 Global Life portfolio, and then we've got Old Mutual International Investment Portfolio Plus. So I think that will kind of cover the majority of it. Some of them will be different, right? So especially on the endowment side, some of them will have 5-year term restrictions, and I think sometimes clients look at it as a negative or like as an obstacle. But sometimes what we need to look at is Do not look at the obstacle restrictions of that 5-year term, but look at the benefit and the tax efficiency that the product brings after the 5-year term. But taking into account, and that's why we actually have multiple products, if the liquidity is a concern for a client or an advisor within the first 5-year period, we do have other products that bypass that liquidity restrictions. And there's a different ways of doing it. So some products we can allow up to 100 purchases within the first 5-year term. But I think it's key to know that if you invest in your money offshore, your time horizon should be a 5-year plus term. So I think that is key to note for.
Alex, the Alexander Forbes offshore pension plan, I believe can you give us the tax implications?
Sure. So on Alexander Forbes offshore pension plan, so if you look at the accumulation phase of the product while you produce it, while you do a recurring contribution or a lump sum contribution into the product, so there's no income or capital gain tax during the accumulation phase of the product. Once the product allows you to start drawing down or decumulating from your investment, what happens is that initially your disinvestments or your income gets paid from the capital portion. So it does not attract the capital gains and income tax. Once that is depleted, then that growth on capital, which is your last part of investment, or the growth of that investment, once you start decumulating from that will trigger the capital gain tax. But it's key to know that the contribution to the offshore pension plan are not deductible for the asset tax purposes.
Okay, and we talk about optimal offshore exposure. Obviously, some want a lot more than others. But can you give us an idea of what you think is the optimal offshore exposure in any portfolio?
So we really need to be very cautious when we utilize the word optimal, right? And all our clients are unique. Their goals, their objectives, their needs are unique. So, but in saying that, we have done that work stream looking at optimal offshore allocation, but that was predominantly more looking at post-retirement clients, looking at growth bucket, the CPR plus 5 portfolio, and we look at it in two ways. Once we started looking at from a backward looking, right, and we look at the data sample from 2004 to 2020, and the optimal offshore allocation was sitting in a range of 40 to 45%. Right? And then we looked at on a forward-looking basis. So the modeling that we've done on that side, also utilizing the CPR plus 5 portfolio and looking at various risk and return metrics. Obviously, your key metric would be your Sharpe ratio, your expected returns, your standard deviation, your downside deviation, and I think the probability looking at your CPR plus 5 over the rolling 5-year period and a 10-year period. So looking at those kind of a key metrics is the optimal offshore allocation was sitting in a range of 25 to 30, where you can see most of the metrics start reducing at 27.5%. I think that's key to note, and I think this is where, or in other words, what you want to say, what your returns reduce and your volatility increase as you increase your offshore exposure to a certain point. So with servicing a wider segment of clients, and some of our clients potentially will never have offshore liabilities, will never immigrate, or might never even qualify for the immigration. And they will work, live, and die in South Africa. We need to take into account that sometimes when a product provider is promoting 100% offshore allocation, it might not be an optimal solution for your clients.
Okay, thank you. Well, you've given us all the ins and outs, so thanks very much. And
pleasure.
Very enlightening. And I just want to dive into the portfolios now with you, Mac, if we can. So Mercer are one of the largest asset management companies in the world. What is our relationship, or Alexander Forbes' relationship with Mercer?
Yeah, thanks, Mandy. The genesis of Alexander Forbes' relationship with Mercer goes back to about 2014, when Mercer secured a part shareholding in Alexander Forbes. And since about 2017, we've looked at how we can leverage the reach and power and kind of intellectual capital that Mercer carries to benefit our own global solutions on behalf of our clients. And we think that the relationship with Mercer works for us because what we find is that both firms share a deep client-centric culture, fundamental belief in multi-management, but not only that, a research-based approach, to investments, as well as a deep belief in responsible investment practices. Today, a lot of our investments, offshore investments, are through Mercer, and we believe that these are well positioned to benefit our clients over the long term.
So what is Alexander Forbes and Mercer's role in the global solutions?
Right, yeah, so just maybe to set the scene around this is to say that Alexander Forbes has managed offshore investments for a better part of 2 decades, right? So it's been over 20 years that Alexander Forbes has invested offshore. And over this time, we've developed a very deep understanding of the different dynamics that are at play when investing offshore. But not only that, we've also developed a very deep understanding of our clients' needs and how the client solutions, how offshore interacts with the local client solutions in making up a total client solution that has to meet the risk and return objectives that we set. So with that understanding, we set the objectives, the risk and return objectives of the fund, and we also set the optimal allocations to various asset classes that we can use offshore. And from that, we then use the building blocks that Mercer manages, and we blend these building blocks together to form a complete a global solution, right? So Mercer are responsible for researching the best asset managers and finding these managers and blending them together to create, an optimal, robust building block that can, stand on its own and delivering on a particular objectives, and put these building blocks together to create a wholesome global solution that can deliver value over the long term.
So, and what does a South African investor does one need to consider when allocating or investing in global equities?
Right. There's quite a lot, right? So, kind of the decision to externalize your assets or invest offshore is driven in part by the need to diversify the portfolio further, right? So, South African market, as liquid and as deep as it is also quite concentrated, right? So, many people tell you that the top 40 is really the true investment universe, available to South African, maybe at a stretch, the top 60 shares in our market, right? So you want to limit that concentration risk and diversify your investments further, but you also want to think about access, right? Access to different markets, different geographies, different sectors, industries, access to different companies that are at the cutting edge of some of the most important things that are happening in the world. Companies like Apple, Microsoft, Google are all available offshore, and you can't access them in South Africa. But also liquidity is very important, right? Which is to say that you want an investment that can easily be converted into cash when needed. So that's very important. But perhaps most crucially, I'd say that one needs to, when thinking about investing in offshore equities, one has to understand that it's an extremely risky asset class to invest in, right? So it is prone to significant volatility, but not only that, significant drawdowns from time to time, and this is something that we need to be aware of. However, also over the long term, this is an asset class that offers significant potential capital growth, return. However, one needs to be very patient. So, just given all of this, given the fact that this asset class is risky, but also does offer a lot of promise returns-wise, one needs to have a long-term investment outlook. So Alex earlier spoke about something like 5 years. If you think about that investment in the context of a minimum 5 years, an allocation to offshore equities might be suitable for your portfolio.
You touched on diversification. What is the importance of diversification in a global equity portfolio?
Yeah, so I mean, kind of as the cliche goes, right? You don't want to put all your eggs in one basket, and that's a very, very important investment principle, right? So you want to, when you have a portfolio, you want access to different geographies. You want to be diversified across different geographies. You want the whole opportunity set. The world is a very big place. You want to also access different sectors, right? So you don't want to be concentrated in particular areas of the market. But not only that, you also want diversification across different managers, right? It's a fact that there is no one manager that will outperform in all market cycles, right? So you want to be diversified across asset managers as well. But so you want sector diversification, regional diversification, you want manager diversification, but also, given the fact that in a global, investment landscape, there are quantifiable factors that have been shown to deliver value over the market, in the long term, right? So factors such as value, growth, quality, momentum, small caps. You want to be diversified across these factors because whilst there is rigorous academic evidence showing that these factors do add value, they also are prone to significant fluctuations, through the cycle, and they don't behave the same through the cycle. So, blending them and being diversified across these factors just helps improve the risk and return dynamics, of any equity portfolio. So this is really why it's important to be diversified at all times in your portfolio.
No, absolutely. And Mac, the Global Equity Fund, can you just expand and talk to us about the fund, but also the importance of multi-management in the fund?
Multi-management is an investment approach that blends different asset managers, right, with different investment approaches, different investment philosophies, and different styles together, to create one portfolio. And in doing this, you improve the returns of the fund, you improve the diversification characteristics of a fund, but also not only that, you actually compress the risk, that you find in a fund. So this is, in essence, what multi-management is in a nutshell. So a multi-manager does not go to the market directly and buy and sell securities, right? So that responsibility is with the asset manager that we've identified and we've allocated capital to deliver on. What a multi-manager does, and kind of one of the key things, it scours the market to find the very best manager for a particular strategy, right? So, there'll be a lot of research done to find the best value manager, the best quality or growth manager. And these managers are identified and are blended in such a way that they kind of meet the optimal allocations, and they also then deliver on the forward-looking risk and return characteristics that are needed in the portfolio. Sort of blending these strategies together kind of ensures that you enhance the probability of delivering on your objectives, and also decreasing the risk in the fund, right? And then just on the second part of your question around the Mercer Global Equity Portfolio, right? So I mean that it is benchmarked against, for instance, the MSCI Global Equity Index. And it consists of 5 managers, all playing different roles in the portfolio, right? So the one manager is MyInvest. MyInvest is a fundamental value manager with a bit of a growth tilt. They look at shares and they try to find the cheapest shares that they think are going to deliver value over the long term. Another manager is Arrow Street, right? So Arrow Street is a quantitatively based value manager that has a bias to smaller cap securities. So that's how we get that small cap bias in that portfolio. And then you have a Baillie Gifford, right? Baillie Gifford is a bottom-up manager, highly concentrated with a high tracking error, which is to say that their portfolio tends to look quite different from the index because they have these high conviction views, and they follow a bit of a quality growth investment approach. You then have Wellington, Wellington, also another quality growth manager, also a fundamental stock picker. And then you have Bailey Gifford. Bailey Gifford tends to have lower risk, so it's one of the managers in the fund that reduces the fund's volatility, also quality growth, and they reduce volatility by looking for companies that have a high ROE or return on equity. And these companies are the ones that tend to be less volatile over time.
Okay, so it's a great blend of managers who have different styles.
Right, different styles, different investment approaches. All quality managers that are A-rated. What A-rated means is that when a research specialist at Mercer rates a strategy and they assign an A rating, it means that they believe that this manager has an above average prospect of outperforming prospectively, right, on a forward-looking basis.
And what was the main motivation for the restructure on the fund?
Yeah, so there are several reasons why we've decided to restructure the portfolio. The first is that we wanted to align all our portfolios with our forward-looking investment views. The other reason is that we wanted to access kind of the full opportunity set available globally and kind of what we get from Mercer, right? So previously the allocation to Mercer was there, however, it was lower than what it is currently. And given the reach and the intellectual capital and the robust ways in which they manage their portfolios, we wanted to express that view more fully. The other reason is that we wanted to enhance investor value, right? So these Mercer building blocks, we think offer very good value for money. We have access to the best research specialists, a wide set of resources, and just a good and a full access to the best practice ideas that are in place globally. And then there were considerations around risk, risk management. We wanted to align the portfolio with the best risk practices, using fully the risk tools that Mercer employed to manage risk. So things like controlling regional exposure, controlling tracking error, controlling sector exposures. All these risks are managed actively and are compressed within the fund and are monitored continuously. And when these risks sort of go out of line, Mercer always takes steps to control them. And then lastly, we wanted to embed the ESG practices more and more into this portfolio, right? So Alexforbes and Mercer share, as I've mentioned earlier, a fundamental belief that in sustainable investing. And given the fact that Mercer follow this and it is an explicit part of the investment process and the research process when they're assessing managers, we thought that allocating to Mercer would definitely enhance the ESG and sustainability characteristics of the portfolios that we offer to clients.
Like you touched on ESG, what is ESG?
Right, so ESG is an acronym that stands for environmental, social, and governance. And increasingly this is something, or this is an area in investments that's gaining more prominence and gaining more importance. Kind of from an environmental perspective, it's just an understanding and an appreciation of the fact that the investments that we make into particular companies have an impact on the environment and the long-term consequences of that. Scientists are talking more and more about climate change. So we just need to have an appreciation of what's going on there and that impact. And then on the social side is just also companies impact society in many ways, directly and indirectly, and investors need to be mindful of this impact. And obviously, you need to be mindful of how to make it better. It's possible. And then governance, there's just companies are managed and are run in sound and ethical ways, kind of following the best practice rules that kind of in place. So, for instance, in the case of South Africa, the King codes 1, 2, 3, and 4, are very important. And companies just need to be run ethically and show their books and show investors and basically align with investors and engage with investors around how to take the business going forward. So that's very important. It's a non-traditional factor or consideration when assessing a company, but we think is one that is extremely important because it speaks directly to sustainability, right? So and Mercer, as we do, take this very, very seriously. And as I've mentioned earlier, it's a key cog in the investment process, right? So they look for managers that take ESG seriously. They have a 4-factor framework where they assess these managers on such things as engagement, firm-wide acceptance, and to what extent ESG is embedded in the investment process. And there's a scoring that they actually assign to it, which with the 1 being the highest, which is to mean that they're a leader in ESG considerations and practices, and a 4 being a lowest, which is to say that they don't see integration being fully embedded in that process. And that score and that rating and that opinion that's raised about a manager flows into the final sort of investment rating of a particular asset manager. So it's something that's that's important, and that's why as I've mentioned earlier, restructuring this fund and allocating more of the assets, the client assets, to these Mercer building blocks has in many ways improved the ESG characteristics, we believe, of these solutions that we offer.
Oh, well, that's great. I mean, I know certainly my clients have been asking me about ESG, so that's super. And if you look at the landscape prior to COVID and now, do you think it's different for investing globally?
It is quite different, for many reasons, right? So kind of prior to COVID, let's talk about like at the end of 2019, right? Markets were overvalued, right? So markets all across the world, global equity markets appeared to be extremely overvalued. PE ratios were very high and they were very stretched. But not only that, there were many signs that the market itself is in the late stage of the economic cycle. The yield curve was flat or inverted, which is a typical sort of tell sign or a leading indicator for recession and a market crash. And of course, that kind of all of that was then brought to bear a bit quicker when the COVID crisis came along and markets crashed, the fastest bear market in history, and then followed then by a very fast recovery, equally fast, the fastest recovery in history. And so we're now at the stage of the market where we've probably gone from the early cycle that was the recovery to what is now kind of the mid-cycle, right? So valuations are not particularly cheap. They're not very cheap. They may be arguably cheaper than they were in 2019. The economy continues to recover, and company earnings continue to improve. So that's a good sign. However, on the other hand, we need to be appreciative of the risks afoot, like the Delta variant and what that might mean as the market tries to grab a full hold of the implications of the Delta variant and the impact that it will have on the global economy. But not only that, there's the risk of inflation that investors are talking more and more about, and the implication of that as well. But also then the language from central banks that they're preparing to withdraw a bit of liquidity from markets in the near term, right? Scaling back on the asset purchases. That will also have consequences around the investment landscape. So in the short term, no doubt, things appear uncertain and very risky, and there could be a lot of volatility. However, as I've mentioned, we're still going through the cycle. The economy continues to recover. Companies will continue to make earnings. And as these earnings express themselves, there will be opportunities for returns. So to answer your questions in the simplest of terms, that it appears to be a better time to be invested now in today's market than perhaps where the market was in 2019 with the risks that were in place back then.
Right. So there's still a sense of buoyancy. That's
right,
great.
Right. Yes.
And emerging markets, I mean, have you considered an allocation to emerging markets in the fund?
Right. Yes, we have, and there is an allocation to emerging markets. Of course, this allocation needs to be controlled in appreciation of the volatility that emerging markets presents. Emerging markets tend to be highly financialized, so there's a lot of exposure to banks, or financial assets, which tend to be quite volatile. But not only that, exposure to materials, right, to resources, which are also very volatile, and then energy, oil companies, which are also very volatile. So this allocation needs to be controlled, but it's there because we appreciate that emerging markets have better growth prospects, as they continue to develop and continue to catch up to developed markets. Economic growth prospects are better. And economic growth is typically tied with earnings growth of an economy. And so if these companies continue to earn, they just make for better earnings opportunities. As it is, emerging markets also offer quite a lot of value. They appear cheaper than developed market equities. And just as an extra diversifier, right? These companies tend to be smaller cap, different regions, and also expressed in different sectors. And adding that diversification in a total global equity portfolio, we think stands to benefit the fund over the long term.
Yeah. And the Chinese have been quite draconian in their regulation. Do you think it poses a risk to the fund?
Well, it definitely does pose a risk. I mean, the regulatory crackdown that we've seen recently has created a lot of volatility, a lot of uncertainty, and that volatility has been felt most keenly in emerging markets. Chinese equity market is about 40% of the emerging market, so that impact was felt keenly then. I mean, China over the last quarter fell something in the region of 20%. And it did impact our fund to a degree. But as we've been talking, the importance of diversification. These allocations are very managed, and the extent of the fall was a tiny fraction of the 20% that we saw. I think kind of going forward, the market participants will continue to be worried about what will happen next. If there are any more regulatory measures that are going to be put in place that might create a few issues and valuation issues for certain Chinese companies. However, on the other hand, we think that there are also kind of opportunities at hand. Some companies, some Chinese companies, actually experienced significant capital appreciation as these regulations were being announced, and we think that there are opportunities in that regard. But I kind of, in the fullness of time, once these regulatory measures have been expressed fully and we're clear what it is, as the Chinese market stabilizes, there will be a good opportunity to invest fully and fearlessly in Chinese assets, going forward, and those will obviously offer their opportunities. I think kind of at a time like this, it's very important, because of the volatility and the uncertainty of having a bit of active management in the strategy. Active managers can see these risks, these regional risks, and discern what's going on and just use their judgment to see what will happen next, and then maybe allocate a capital away from these risks, into other opportunities that perhaps carry less risk and maybe better opportunities for returns in the short term.
And Mac, the performance metrics of the fund?
Right. So, yeah, I mean, there are quite a lot of metrics that we look at, kind of specifically for the global equity portfolio that we've been speaking about. It's a global equity portfolio, which is to say that the principal is expected to be fully invested in global equities and is benchmarked against the global equity market, in this case, the MSCI ACWI, or the All Countries World Index. And kind of the overriding return objective is to generate growth and inflation protection over the long term. But because it's benchmarked against the MSCI ACWI, we expect the fund to deliver outperformance over that benchmark, again, also over the long term. And by long term, we mean kind of a minimum 60 months. So the kind of the KPI of the fund, the performance on these outcomes are measured sort of reliably over any rolling 60 months. And then kind of from a volatility perspective, we expect that the volatility of funds should not exceed 28%. However, we expect the range, the typical range of volatility to be between 10 and 20%. And at no point should the fund experience a drawdown that's in excess of 30%. Right? So, that's what we deliver on the fund. So if the fund can deliver on all these metrics and objectives, would have seen it to have delivered on what it had to deliver on. Yeah.
Excellent. And the burning question, Alex, is when are these funds going to be available?
So Mandy, these funds are actually already available on various platforms. So our funds are available on Glacier, on Old Mutual International, Momentum. Some of our funds available on 91. And we are in conversation with 91 to extend the range of our strategic range to be added to the 91 list, and with Adam Gray. So once that is complete, we really want to have that accessibility to our strategic range. Let's call it supply agnostic. So that's accessible to not just to our internal distribution, but accessible to the IFA market or to direct clients. And some lists will load the funds differently. Some will load as a broker funds that is only accessible to your internal distribution, or if it's requested by specific FSP or an IFA to have accessibility. And some of them will load it as an open architecture. So let's use an example, an open architecture structure on Old Mutual International. If I'm a direct client, I will be able to see our strategic range on that platform, and the same thing on Glacier. So, yeah, but to conclude in terms of a fund availability, we do have offshore product guide and offshore guidance notes that kind of gives a technical breakdown of fund availability, the technical specs of the documents, the pros and cons of offshore investing. And those documents are available for internal distribution. And obviously, if we're talking to IFA market, then they're more than welcome to engage with the investment specialists or the broker consultants, and we can make those documents available to them on request basis.
Thank you, Alex, and thank you, Mac, for those insights. There's no doubt that there are benefits to investing offshore, particularly from a diversification perspective. So thank you very much for joining us. We hope this discussion has helped you unpack our offshore offering. And if you have any further questions for Mac and Alex, their details will be provided in our post communication. So take care and goodbye.